Hello and welcome to a CMS Forex daily video recap. I'm your fundamental market analyst, Nick Nassad. Today is Friday, August 27, 2010. We got some clarity this morning from the Fed Chairman Ben Bernanke as he outlined what it is he believes a central bank can do should the economy in the US weaken further. He said more purchases of long-dated securities could be employed, that the Fed can be more explicit in its commitment to keep interest rates low, or it could lower the already rock-bottom rates it pays banks to hold reserves at the Fed. The Fed will be vigilant and proactive if inflation falls by a significant amount and will strongly resist deviation from price stability in the downward direction, words meant to soothe worries over deflation. That being said, the Fed chairman seems to believe such options will not need to be employed, saying despite this recent slowing, however, it is reasonable to expect some pickup in growth in 2011 and in subsequent years. In other words, he downplayed concerns that the economy would fall back into another downturn or a double-dip recession. The results were twofold. One, initially the US dollar found some strength as Bernanke didn't bang the drum for further monetary easing, though he continues to hold that option in reserve. Stocks rallied rather strongly and bonds sold off a bit as they had been in demand lately, partly due to the fear of deflation. So, with no additional monetary stimulus imminent, the message was an attempt to rally public confidence that the recovery still has enough staying power to survive until hiring and spending pick up next year. While recognizing risks at various points, he did not express significant concern about potential downside surprises ahead, framing most of his comments in terms of continuing to promote moderate recovery. Taking a look at the euro-dollar pair, with stocks taking Bernanke's message as a sign to gain, the euro and other high yielders rallied in early New York trading, extending the upward channel we had seen in this pair over the last 4 sessions. The situation, however, hasn't really changed much, and without extra quantitative easing measures, the US dollar should continue to find demand when we have poor economic data and risk aversion in the markets. However, that wasn't the case today. Now, I did mention that the US dollar did strengthen following Bernanke's comments, and that was this candle here as we dipped down to the 1.2675 level, but with stocks rising, we did see the pair those initial losses and move up to the 1.2778 level. Now we do close above 1.2730 to end the week, which I had been mentioning as a very important level, first as support in last week's trading, then broken and acting as resistance throughout most of this week, but now we are ending right at that level as well as where the 200 period moving average is. So we'll see if we stay confined within this upward sloping channel, or if we see another move downward if we continue to have pricing in of a weaker global recovery. The US dollar Japanese yen pair, meanwhile, rallied pretty strongly today, pushing back above the 85 level and even breaking a recent downward sloping resistance trend line as well as the 200 period moving average. The lift in market sentiment following comments by Bernanke, along with the continuing threat that Japanese officials will take action against recent yen strength, are supporting the dollar against the yen. In the battle of these two pairs, the yen is the stronger safe haven. If we take a look at a second yen cross, here we're looking at the Australian dollar versus the Japanese yen, we see similar price action, with the Aussie gaining rather strongly in today's session. We did have pressure from the Japanese government increasing on the Bank of Japan to speedily take further steps in order to help spur growth, which weakened the yen as that implies perhaps more monetary easing down the road. With higher stocks in the US and the yen on the back foot, the Aussie yen pair move above its recent broken support level at the 75.75 level, reaching a high all the way at 76.75 by the end of today's trading. And here too we break this downward sloping resistance trend line that matches up rather nicely with our 200 period moving average in a 1 hour time frame. So here too, this is a big change from when we entered the week with the pair plunging in favor of the yen on speculation that the Bank of Japan wouldn't intervene in currency markets in order to prop up the yen, but that sentiment seems to have shifted to end the week, and we actually end the week higher than when we started at around the 76 level. The Australian dollar US dollar pair, meanwhile, also moved higher, breaking above the 200 period moving average and its downward sloping resistance trend line that we see here, with the pair reaching a high near just below the 0.90 level. So that was close to a 50% retracement of the full swing we had from 0.9290 down to 0.8770 that we could see there. So this is an interesting development for this pair. Here too, we had a pretty important Pretty important support trend line that was broken, but then we moved back above it and used it as support. So that was the 0.8850 level. We see that we had tested that as support a couple of times in the last few weeks, broke below it during this week's trading, and now moved back above it. With the break of this downward sloping trend line, we could be developing a bullish case for this pair, but we did see a rally earlier this month that fizzled. So we'll have to just monitor what happens next week. Our next important level of resistance to the upside is 0.9060. Taking a look at another commodity currency pair closely tied to global growth and risk sentiment, the US dollar, Canadian dollar. We had seen the pair moving in favor of the greenback throughout most of last week and early this week. But now, following a test of 1.0660 and that level holding as resistance throughout early this week, we moved to test that level again following Bernanke's comments, and following the rise in risk sentiment and stocks in the US, we saw the pair moving in favor of the Canadian dollar, retesting its support from yesterday's session around 1.0520. Now that's close to the level of resistance turned support for this pair that we had seen at 105. Around that 105.20 level. That was our resistance back in August 20th. That was broken and now is acting as support. So it is too early to say that we have had a change in overall risk sentiment. As you can see, the greenback had been gaining throughout most of August on the back of pricing in of weaker global growth. Doesn't seem that the situation has changed all that much, except US data has even gotten worse. Now, next week we do have some important reports coming out from around the world, including Chinese manufacturing, which could help to move sentiment in either the risk on or the risk off position. In the US, we have several releases to end the month of August and begin the month of September. We start with personal income and spending, which are expected to show increases. That's followed by the S&P Case-Shiller 20 City House Price Index on Tuesday, as well as FOMC meeting minutes. Wednesday, we get ADP employment change, expected to show a small 22,000 increase in private payrolls. That on the same day, we get the ISM Manufacturing Index, while showing overall activity increasing as we stay above the 50 level. It is going to be slower than what we had seen in July. Pending home sales expected to show a 1.5% decrease, and then on Friday we get non-farm payroll report expected to show around a 100,000 decrease, though private payrolls also expected to show a small 20,000 increase. And then we end the week with the ISM non-manufacturing index expected to post a print of 53.6. And that will wrap up our coverage of the Forex market for this week. For more news, videos, and analysis, please visit our site, cmsfx.com. I want to thank you for watching and wish you a great weekend.